Welcome everybody to a special edition of Macro Insiders, where I'm going to be having a chat with Julian Brigden, who's the CEO and founder of MI2 Partners. And what I really wanted to get to today was some great calls that Julian's had over the last number of months, actually very consistent. And I think there's four that I wanted to kick off with, which I'm going to go into. And I think that they're really just sort of define where we are. And they were great calls that he's had. The first one was really on inflation and how it would blindside policymakers. The second one is that the bond market was therefore wrongly priced. And this is many, many months ago. That growth stocks would therefore also come under a lot of pressure because they are very much connected to that yield and inflation story. And that within all of this, commodities would perform quite well. So I really want to just kick straight into it because I want to find out where your thinking is now. And policymakers were blindsided. Are they still going to be blindsided? And more importantly, not just blindsided by where inflation could go, but more importantly, I guess, where it may go from here in terms of if it has peaked or when it peaks, how quickly will it subside? Where's your thoughts on that now?
So are they blindsided? Well, I think, look, we can see from the Fed, that very unusual, not so subtle nudge in the Wall Street Journal, right? That they're going to go 75 this week, the Fed. I think it's pretty clear that they are getting very concerned. It doesn't mean that all central banks are there yet. I mean, there's one, I think, glaring omission, possibly two, but the biggest one, I think, is the ECB. I think that it's really, really dangerous for people who are tempted just to look at the US Treasury market, for example, and just ignore what's going on in Europe. Because as you know, Roger, for many years in the business, the most fungible outside FX of all global markets is the bond market, right? You can create one sovereign bond market out of another sovereign bond market with an FX swap. So, if we start to see, and I thought Lagarde's, I mean, if you remember your old days going back to the sort of Eurovision Song Contest, you would have given her nul point, right? No points for her delivery because she delivered. And we got a falling euro, sell-off in the bond market, and a collapse in the DAX, right? I mean, 0 out of 3. I mean, I just don't think there's any credibility there at this sort of point. And I think that poses a huge threat to global bond markets if those German yields keep going. Is this over? I mean, here's the thing. Our work has consistently shown, and this is what we've said consistently, that the pressure just from a stimulus perspective in the United States continues into the end of Q3, beginning of Q4. So let's argue we've got another 3-4 months. In that time period, those prices continue to rise. It doesn't take account of what, any snafus in the system that we might have seen from China shutdowns or from Ukraine. This is simply just excess demand created by a stimulus which in historic terms is 5 times larger in monetary and fiscal terms, according to our work, than anything we've seen in the post-war period. So that has to work its way through. Maybe I'm trying to be too cute and think it keeps going up there, but the point is this stuff isn't going away quickly. You can look at it today. I mean, you and I, just as before we got in the air, were chatting about the old series of PPI. So we got the final demand, final goods PPI this morning, and it, at face value, you could argue it looks like it's beginning to top out, right? We've had a 10.9. Now we've got a 10.8 on the year-on-year metrics. But if you go look at the old series that goes back to the late 40s, this is the second highest print. This thing went up 1.2% this month, right? I mean, this was just another explosive jump in prices, and it's now outside the oil shock of 74. This is the largest increase that we've seen. And the real question, and this is the thing that why I've been so worried about the equity market, is how do these prices get apportioned? Right? Because, I keep using a quote from the chairman of Restoration Hardware, which I think is incredibly apropos, which he made a few months ago. And he was talking about what happened, where did I get it? Yeah. He said, I don't think anyone really understands what's coming from an inflation point of view, because either businesses are going to make a lot less money or they're going to raise prices. And I don't think anyone really understands how high those prices are going to go everywhere. So in other words, it was either, when it comes to the apportionment of that PPI, it was either going to go into margin compression because companies couldn't pass it on. And we might have seen the beginning of that, Target, Walmart, et cetera, or it was going to get passed through to end users, customers, and then you were going to see rampant inflation, which means that the bond market remains mispriced, which means that central banks have to tighten more. Neither of those outcomes I see as particularly positive for risk assets.
Yeah, but I mean, within that, I suppose one of the other things as well with this inflation, because there's a lot of chat at the moment going, as you just alluded to with PPIs, has it peaked? And I guess for policymakers and for just real people, I suppose as well, is that it's not just whether they peak, but they need to come down damn fast to actually make us feel better. And what's more, it seems that this all started with durable goods, but it's now gone into essentials. It's energy, so it's petrol prices, gasoline prices. It's
in services. I mean, services horrible.
It's the stuff that really starts to hurt. So I didn't have to. If wood went up in price, lumber went up in price, I didn't need to do an extension. But if food goes up in price, if petrol goes up in price, so even if it doesn't roll over, it's embedded now in stuff that really kicks us in the wallet. And as at the moment, wages have gone up, but real wages have been collapsing. So this is a serious problem. So in some ways, does that mean that yes, we could peak, but a peak is irrelevant if it's just sticky within these very sensitive items?
I think if you listen to what if you listen to what Powell has said, this is a gentleman who I'm told, is the most hawkish member of the FOMC at present. Remember this, that's important because remember, it's not a democracy, right? So if Bostic doesn't like it and he wants to pause in September, then the guy can dissent, right? But, Powell has made it absolutely clear, and he said, we need to see clear and convincing evidence that inflation pressures are abating and inflation is coming down. And if we don't see that, then we will have to consider moving more aggressively. Well, that's what you've just got, Roger, right? You need to see, to get them to back off, month-on-month prints that are running, really ideally at 0.2, right? But let's say 0.3 month-on-month, and we're not even close to those type of numbers, right? Not even close. That's why that CPI was such a bloody train wreck last week, because it increased at 0.7 month-on-month.
Yeah. And then I guess, what really matters for us all, though, is that, we can be right on inflation or wrong on inflation, but what's more important is being right on the risk assets. And you talked about bad for risk assets. So let's go with the bond market first, because you said bonds were mispriced, and they were. And as we speak, yields are making new highs. Yep. We've now had another reinversion of the 2s10s yield curve. They are not showing signs of abating, and we have now created, for the first time in this very, very long chart, a new high that's higher than the previous low. Yep. So where do you see these things going? Because when I talk to people out in the market, they range from we should still be topping somewhere around here to 8%. Where are you in that range?
I mean, it can't be 8%, Roger, right? It just can't be 8%, right? I mean, why don't we just go and set a thermonuclear device off somewhere, right? I mean, that's
growth will die before then.
I mean, the world would be over it can't be 8%. I look at something like bunds, which I think to some extent are driving this now because they're way behind. And, we had an initial target. We flagged it in February to the sort of MI2 client base, not really the macro insider client base, because it's not really something you can trade. We were very bearish on fixed income, but, it's a difficult one to trade. And we said 155. And then we came out and we said, kind of just slightly over 2. We're heading in that direction now. I can see, if I look at rates of change in some of these futures contracts, another 1.5, 2 points from here, and you would hope to see some sort of, you would hope to see some sort of pause, right? Pause, bounce, slight correction. But it really does depend. I mean, the problem that I've got, Roger, is when I look at long-term trends, and I think that when you're looking at very long-term trends, 40-year trends, for example, right? I think you need to look at a log chart. And when I look at that, I think I can share a screen. Correct me if I am wrong. But, okay, so can you see that?
Yep.
So this is the logged chart of the 10-year Treasury going back to 1982. And you can see numerous touch points, right? 4 very clear ones. We break it, at the beginning of May. We come back down, we test it. We're now at, 3.5, basically. I mean, 4? If that doesn't hold upper 5s. I mean, I think, one of the other things to bear in mind, Roger, is we're still actually giving the Fed the benefit of the doubt. Now, I think, in fairness, recent action is commensurate with, a tough Fed, right? So you don't have to be so worried, at least at the moment, that you think that the Fed is going to whittle away the value of your money. But if you go and look at the term risk premium, which you understand, but let's explain it to people. I mean, basically, think of it as like the insurance that you demand when you write if you're the insurance company and you're writing fire insurance, right? You demand a premium. You demand a premium for covering that risk. Well, the term risk premium is the premium that the bond market demands for taking that duration risk, buying a long dated bond, okay? And it is essentially a proxy for Fed credibility, okay? It is still negative. In other words, we're not seeing any risk that the Fed would let this thing run away and erode the long-term value of our debt. But if you look here in the 60s, which is kind of the last time that we had such a low term risk premium, we went pretty damn quickly from 65 to early 70s to 250 basis points. And then ultimately, as inflation really got out of hand in the 70s, all the way up to almost 500 basis points. So the point is, Roger, you start to see things like this. You start to see the Fed lose their credibility. And I'm not arguing that they are. I think their steps are really aggressive. I mean, I could see, though, the ECB starting to lose their credibility and that dragging up global bond yields. So I think I struggle long term to see any value in global bonds outside a trading tool for risk off and risk on at all. And I also think that it's important to bear in mind that the demographics are moving horribly against treasuries and fixed income in general. I mean, I think this is something that people get wrong. So this hasn't been updated because we have to manually update it. But look, this is a demographics-based model. And basically what you're trying to do is you're trying to look at the sort of mix of, how old the population is it working, is it saving, and whatever. And I think one thing that people get wrong is that they say, okay, well, when we all retire, we'll be spending less money. Absolutely right, okay? But that's why this curve is less pronounced in its rise than this decline, okay? But the point is it's not about spending money that determines the asset prices. It's actually saving that money, right? So when you're at your peak of your earnings, as the baby boomers were starting in the 80s, and you start to work very hard, your peak savings, you're taking those savings and you're investing them in something. You're investing them in stocks, you're investing them in bonds, and that's when those asset prices rise in value and yields, in the case of a bond, fall, right? They're the inverse of the price. And that's what happened, right? Now, they're actually flipping around. They're retiring. They are going to spend what they saved here. They are going to dissave. When they do that, definitionally, unless you can find some other borrower or purchaser, and could come to that in a second, Roger, we can explore that topic, right? And bond yields are inexorably going to rise from here. I mean, don't get me wrong, you could get big swings. I mean, this is, point, where are we now? You're kind of here. This is 0.5%, and this is 5.5%. Basically, you get a 5% swing in yields, right, in aggregate. But the trend is up, mate, because this is a demographic of all those countries that buy US Treasuries. So I struggle really to see any value yet in fixed income. So that's why I still remain horribly bearish, and I'm getting really worried how far this correction is going to go in some of these long duration NASDAQ kind of plays, US stocks in general, which I think are dominated by these plays.
I mean, that kind of brings us on to, because we're talking about these assets coming off a bit or a lot, but it kind of goes down to that thing, which is, okay, the Fed's got to fight this, and the Fed clearly went from growth to going to price. So rather than supporting growth the last 30 years, moderation, etc., to now basically having to try and cap price, which needs a tightening of financial conditions, as you've talked about before. And you can do that through wider credit spreads, higher bond yields, stronger dollar, or lower equity markets.
Right.
Which of these do you think is the most likely way that the Fed is going to try and get control of this? Because in my view, this is a scenario where everyone's going, 20% down, they're going to relent. But if they relent, inflation goes up, and inflation now is impinging on growth and will kill growth if it goes too high. So you have to stop inflation first before you can ever start thinking about growth again. Hence, equity market over there, forget about it. We're going to do this tightening of financial conditions. Which of those cogs do you think is the one that they're going to really aim at to try and get these financial conditions to a level where at the moment they're just where they've been for 20 years, bottom end sort of thing?
Well, I think, okay, so let me share another chart with you. Look, I think the Fed has acknowledged that they made a mistake. And I think now they're trying to address that mistake. But it isn't going to be easy at all, Roger. And I think the problem is if you, and I'm glad people are starting to understand this concept of financial conditions, because it's something that they didn't, right? You constantly hear, these cheerleaders that you get on financial TV, particularly the equity guys, come on and say things like, well, we've priced in 4 hikes. That looks like the market can take it, inference being we could rally. And I'm an old git, and I'm entitled now to shout at the screen, right, and throw my slippers at the screen, and I would, because my retort to that was, well, if you can take it, then it isn't enough, right? Because the whole objective is to tighten financial conditions, not just raise rates, right? It's like if the tree falls in the wood and no one hears it, did it fall, right? If bond yields rise and nothing else reflects that, did they rise, right? So when you look at financial conditions index, roughly you can sort of parse them into 5 things. So short-term interest rates, long-term interest rates, credit spreads, stocks, and the dollar. And what you can see here is our calculation is to be conservative, we need to get financial conditions to a point where growth is at least at trend. And Powell told us where that is. That's at 1.75% in real terms. And the last time we were there in a tightening cycle was early 2019. So if you sort of go through and you look at everything relative to where it was in early 2019, you can see up until yesterday, bond yields were pretty fairly priced. Now they've blown out of that range. Credit was pretty fairly priced. It's blown out the top of that range. This is 5-year CDX, so that would be HYG falling even further. The dollar is actually pretty strong, but look at this baby, right? Now I'm being generous. I'm taking the equally weighted S&P as opposed to the headline one, which tends to overweight the FANGs, which were even more exaggerated. But this would tell you still that we need to see a 1,300 point, conservatively, a 1,300 point, a 700, well, a 1,000 point correction or 1,200 point correction in the SPW. Okay, so we've got to go from where we are now, basically 5,500 to 4,300, conservatively. Okay, conservatively. And the point is that the longer that these things hang out and the longer that we have people saying it's down 20%, now this is your buying opportunity. And I was in the shower just now and I was listening to them on CNBC again. I like to sort of self-flagellate and torture myself like that occasionally, Roger, right? And they were saying, oh, well, at 20% down, you really need to get your buying list together. And I'm like, yeah, I mean, if this was a normal environment, but we've just shown you, we just have the highest PPI pressure bar one event in the last 74 years. So you think this is normal? You think this is 2018? You think this is 2019 when the Fed pivots? Not even close. So why shouldn't we consider a dot-com style bust? Because I think the equity market was in a dot-com style bubble. And then if that's the case, you've got to look at the size of the declines that we saw during that period. We saw enormous declines post the dot-com bubble.
And with that, I mean, if I was in the Fed, or if you were in the Fed, or all that sort of stuff, you got these various tools. Now,
yep.
I guess the problem is that, high yields is going to kill the equity market.
Correct.
We've seen that, and it's already happening with the yields going up and equity market going down at the same time.
Yep.
Credit spreads widening out will kill the equity market. The one that's interesting that, if I was in the Fed, that I know it's probably slightly opposite to what you think, but I'd probably go, well, why don't we just try and let the dollar go higher? I mean, for the last 20, 30 years, but the last 10 years has been globalization, don't want the dollar screaming higher, tightens financial conditions, bad for everybody. But now, surely, if you can, I know that the dollar and commodities have actually been in lockstep together in an unusual way, but
unusual way, yeah.
Wouldn't they go, if we can get the dollar higher, we can potentially break the commodity market. It's going to be hard work because of supply issues. If we can get the dollar higher, then mom and pop and US consumers should be better off, because they're screaming out in pain at the moment, as you can see from the lowest ever Michigan consumer sentiment, even when you extrapolate back to the 50s.
Yeah.
And the ISM is strong. Now, that's the big corporates that export. Okay, so you're still going to hit the equity market if the dollar's stronger. They love a weaker dollar. But surely where the ISM is, you go, the ISM, big corporates, lots of exporters. Why don't we try and get the dollar up? It's still not going to be great, and it's probably going to be worse for everyone overseas. But isn't that where they should go and try and this first? And, they've done all these dollar swaps in the past whenever there's a problem. But today, you know what? That's the one I'd want to pull, because there is a chance that, mainstream America, who are absolutely screwed at the moment, are the ones who might benefit from that.
I mean, it's very tough, Roger, right? It's extraordinarily tough. I mean, we have never seen, really, I mean, with the exception of things like, when the BOJ came in and drove dollar yen off the lows, a move in intervention to push the dollar up, right? We saw Plaza, and then we saw, periods where and the Louvre Accord, where we've seen, kind of push the dollar down. It's just very difficult for the Fed. I mean, for a start, it's not technically the Fed's remit even, right? It's Treasuries. So, I mean, could you engineer it? Well, I mean, you're seeing it, right? I mean, if anything, you are seeing it. I mean, the trouble is that, as I said, let's imagine the euro goes to 80, right? Let's imagine the euro goes to 80, and the feed through into energy costs in Europe is just off the charts. Right? I mean, you said, you look at German PPI or Eurozone PPI, and it is Buzz Lightyear to infinity and beyond, right? Let's say it goes to 50-60% year over year, and a third of that gets passed through, and you get 20%, inflation in the Eurozone. That's an inflation-fighting central bank, right? Ultimately, I know that they've bastardized their metric, to all degrees, and maybe they'll have to come up with some sort of sticking plaster that they can come up to hold the Italians and the Spanish and the Greeks in there. But at the end of the day, right? I mean, that's a tough central bank. I mean, what does the BOJ do when, if inflation in an environment where dollar yen goes to, 170 hits 5%, right? I mean, the dollar is maybe in an ideal world. I don't see that as a viable tool, mate. I'm sorry.
Because the reason why I sort of bring it there is that, as you mentioned, the ECB tried to go sort of hawkish and then dialed it back. And as you said, the euro goes over because we're seeing BTP yields screaming higher. The problem Europe's always got: if you tighten, yields go higher, and governments and banks, particularly in the southern part of Europe, come under a lot of stress. So the euro is kind of in a difficult spot. We'll come on to Japan in a minute because we have to. And I thought Monday's price action was really fascinating because, with the dollar index recently going up, most of it has been the oil importing countries' currencies down against the dollar, and the commodity, and particularly oil exporting countries, doing quite well.
Yeah.
But on Monday, even though oil edged back to a new high, you had the Norwegian kroner down, you had the Australian dollar down significantly. Obviously, pummeling of the sterling, pummeling of euro. But you saw this sort of, the dollar was up against everything, including those commodity exporting countries. And then you've got Japan, who, if they continue with yield curve control, then you have to have the release valve through the currency. Although they're trying to say, we don't want the currency to go below 140 and we want yield curve control. So that environment just sort of feels that this may be the tightening of conditions does come in a slightly favorable way from the US if it's the dollar, even though it might not be long-term sustainable, because all these other regions are equally, if not more, screwed.
Yeah, I do. The only problem is, and don't get me wrong, I mean, in kind of as you alluded to, you've sort of got, without getting the equity market down as much, right? Fine, rates are going to cause a lot of damage. We know they are. The dollar taking a bit more strain, that's kind of preferable. The problem is trying to leave the equity market out of the equation in the US. I don't think it works, and the reason I don't think it works is what I call hyper-financialization, right? This correlation that exists between the real economy and the equity market. And by that, I mean, if you go and look at, say, employment, right? You go and take the JOLT survey and you put the S&P against it, it's the same chart. You go and look at claims and you put, the equity market against it, it's the same chart. You go and look at CapEx and you put the equity market against it, it's the same chart. And the reason is that companies now are rewarded, and CEOs in particular, management teams are rewarded not to produce a good, right? I mean, up until a few months ago, we didn't even reward them to make a bloody profit, right? They're just shepherds of an equity price, Roger, right? They are literally paid to drive that equity price higher, come what may. So the minute that equities start to wobble, you see exactly what we've seen in the headlines over the last few weeks. Coinbase, all these other tech firms stopping hiring freezes, laying a few people off, right? And the problem that you get is if you're the Fed and you're trying to slow an economy, which is growing above trend, right? This is the big thing that people don't understand. This isn't really about inflation anymore, right? Powell has made it absolutely clear he wants to right-size the demand and supply in the labor market, right? Because if you don't, even if you believe ultimately this inflation is at this point, I don't want to use the word transitory, but ultimately it would dissipate at some point, right? If the labor market remains too hot, it will not, right? You will bake it into the system, right? History tells you that if you allow wages to increase, and Atlanta's increasing at over 6% now, and it's a far better index than average hourly earnings, you're going to bake it into the system. So you have to not just see inflation come down, you need to slow growth, really slow this economy down. Given that hyper-financialization, that relationship between the equity market and employment and CapEx, et cetera, it's going to be very, very hard for you to do that in an environment where equities remain this high. And I think the reason that equities are simply this high is because people do not understand that this time it is materially bloody different, right? They've been taught the Fed is your friend. The Fed is your friend. You see these people on CNBC who are doing an enormous disservice to most investors saying, you can't time the market, right? Stay invested. What bullshit, right? There's a whole industry that Raoul and my clients and half the piece speakers on Real Vision cater to, the hedge fund industry. Their whole job is to time the market. You can use stupid, silly little moving averages that I do to help you time the market, right? Your performance, if you get in and out, doesn't have to be at the arse high or the arse low, is much better if you time the market. But you've got this whole industry that has just grown up that makes their money from you being invested, so they get their fees, right? They're about asset gathering. They're not about asset performance, okay? And this to me is just the criminal nature of the system that we have set up here. Roger, and that's what we try and address with macro insiders. As what we've been telling people for a while. Look, you need to be cutting down on your risk and raising cash, because the point is if you're fully invested and the market drops 60%, unless somehow you get a nice windfall because granny, kicks the bucket at the lows, right, and you take that money and you invest, if you're fully invested, you have no cash to recommit to the market. And we've seen periods where it could take you a decade plus to get back to those prior highs. I mean, that's a long time.
So I mean, let's go on to that, because this is somewhere, we're 21% down or whatever we are now on the S&P. How deep can this go? How deep do you think it will go? How long will this last? So the other thing we've been conditioned to since 2008, even since 2003, is that things go down and within 6 months are back to where they were again. They're straight back up. How long could this last? If we get a recession, when do we get the recession? How long will that recession last? Is this going to be something which is, because the nature of the reaction function of fighting price, which might be stickier than people expect?
Yep.
I mean, are we talking here about something which, could last for quite a long time? Because for me, what I'm seeing at the moment is a market which is more like the death by 1,000 cuts, in that it goes down, but it never has that coup de grace, that sort of sucker punch capitulation, which everyone goes, that's it.
Right. Yeah,
it goes down, and then just when you think it's going to really have a bad day like it did on Monday, it sort of tries to get back up again the next day, and everyone goes, that's it.
Yeah.
It feels
and I think
like
that's really problematic, because it never gives you the opportunity to get in, right, at that, or to get out, right? Because you really want the rallies to help you get out, and you want the pukes to get people short, right? You get the big rallies and the hedge funds go boom, 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 boom. Thank you very much, right? And then it means that you've got a constant buyer kind of on the way down at certain levels, right? And it gives you liquidity. So you ask how much it can go down. Well, I've been saying to clients that it feels to me, ARK feels to me like the NASDAQ did back in 2000, right? I mean, the chart, you can call it a little bit of chart porn, to excuse the expression, but basically, it is that. It's a bit of fun, unless you were long ARK, of course. But the analogies, I think, are really profound. So if you look at this one here, this is ARK in 2000. Okay, so this is the NASDAQ in 2000 in blue. This is ARK. Okay, now, I mean, these are standard pattern. Raoul calls it the GMI crash pattern. I call it a classic bubble. Okay, but this is just a chart pattern that you can go back and look at myriad of different examples throughout history. So, this to me felt like the NASDAQ in 2000, because the NASDAQ, people forget, the NASDAQ back in 2000 was really an embryonic version of its current self. Yes, so some of the names were the same names. I mean, there was Microsoft in there, but it was tiny in comparison to the behemoth that it is today, right? It's the amoeba back then. So how long does this go? Well, I mean, if you want to take this really to a fine point, we don't see a low until September of 2023, okay, in ARK. And then really it takes you a decade plus, 2036, for you to get back to those highs. Now, I think when you look at the big markets, you need to think, where do those go? And if you can see this chart here, you get, this is the NASDAQ. It topped in March. It didn't base, as I said, for 2 years plus, almost 2.5 years. It had dropped 77%. Okay. But that was a really specky market. So let's say that's just ARK. The S&P topped in September, and then it dropped 72%. And the big boy actually peaked in, I would say really peaked in May. I mean, you could take this, but it kind of held in much, much better than everything else. And the real peak in the Dow was in May of 2001, when the US entered recession pretty soon thereafter. And then it dropped basically 50+%. So I think we need to think of the possibility, Roger, that we could drop in, let's call the NASDAQ now the S&P back then, okay, because it's, and let's call the Dow, the S&P the Dow. So I think, could you see 55% off the S&P? Could you see a 70% decline in the NASDAQ? I mean, I hate to tell you, it's entirely possible. I mean, I was just looking at this. So if you look at the 40-month moving average on the NASDAQ 100, you've only seen 3 real closes below that level: 90, 2001, 2008, 2009. We're closing, I mean, we're 2 weeks to go, but we're below that level now. From that point where you get at the moving average, you dropped 53% here, 42% further here, and another 16% here. So even if this is something benign, and I just said to you, I think we're seeing inflation levels the like of which we haven't seen in multi-decades, another 40%, isn't that, why couldn't this thing go down to 8,000?
I suppose one of the problems that we've got is, we talked about this before, which is really from 2015 to 2020, basically 2020, the driving seat in the equity market was these rules-based funds, which had inputs which were not valuation. They were unemotional, they were dispassionate, they didn't do surveys, and they just 401k and kept on buying it. And their major input was things like volatility. Not VIX, but realized actual market volatility. Problem is, we've now got to these sort of very sticky levels of realized volatility out to 100 days on the S&P, which is around about 30. It's the same level as the VIX now. Quite rare that we see the two together. But it means that, and I think this is what we've been seeing, because you get these bearish sentiment reports, and you get everyone going, oh, this must be the low to trade because everyone's so bearish. Market rallies, and they immediately run into more selling, drip, 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 because volatility in bonds and equities are the point where these guys are just unwinding. And it's not deleveraging we saw in 2020 or early 2018. This is, okay, we're just reducing. And our only input is volatility and a few other factors. And I think that means that, we could just be in this drip, drip selling mode for a while until eventually, because I think we're kind of in a rotation mode at the broad level, like you talked about in 2000.
Yeah.
We haven't had the correlation event because the emotional characters keep on buying the dips.
Correct.
And they're getting run over, and eventually that's going to be the correlation capitulation event. But still feels we're a long way from that.
It really does. I mean, we wrote something today, and you look at the, is this sort of the capitulation zone, right? And there's nothing really that suggests that. I mean, if you look at the VIX, right? The VIX is quite a strange little market. In that it trades in bands, right? 1, 2, 3, 4. Well, 1 is sort of every day, 10 to, let's call it 30. 2 is 30 to sort of upper 30s. 3 is upper 30s to upper 40s, lower 50s, and then Armageddon. Right? Now, I'm not suggesting that we need to see Armageddon, the GFC or COVID, but you would think to see some sort of capitulation, you need to get up into this zone here. Well, you can't. And we know the reason, Roger, is because the pros keep buying vol, right? They keep buying hedges. And so you're not getting that sort of puke. I mean, another thing you can look at is you can look at the cross correlation of stocks within the S&P. And it sounds a little technical, but it's really not. What it is, it just looks at the correlation movement between all the stocks in the S&P. And the reason this is important is when this goes towards 1, the long-short equity hedge funds who, are long one stock and short another as they play these various sort of thematic kind of things, the correlation going to 1 means there is no more hedge, right? Everything is moving in the same direction. They have to degross the books. And that typically is kind of one of those moments, okay? And you buy that. We're at 0.5. I mean, there's just no stress. There's no puke in risk.
Yeah, I mean, you can see this with the VIX. I mean, the VIX is high, but it's not expensive. So it's at 30, but realizes at 30. And what's more, the front month is slightly above back month, only slightly. But until the most recent puke, it was a flat line out 6 months. So no one was really saying, I'm worried, I'm stressed. You're not getting that. If you look at volatility, that's actually at 5-6 year lows.
Right.
It's ridiculously low. Now, a lot of this is because 2018 and 2020 took a lot of the structured shorts out of the market, structured short vol. But nonetheless, as you say, institutions are buying this fair value vol. So therefore, dealers are getting short. And when you eventually get the final denouement, you will get a move higher in vol and in VIX, and it will go through those bands, and it will be on high volume.
Yeah.
I haven't seen it even close yet.
No, and that's why I just struggle with this. That kind of that nagging question you get from the back of the car: are we there yet, Dad? Right? And the answer is no. I don't. I hate to tell you, I don't think we are. I mean, it doesn't mean that you couldn't get little bounces, but I don't think we are.
I'd like to ask a few questions. I've tried to cover some of the questions that we've had in.
Yes, absolutely.
From viewers with what I've done already, but there are a few others. Now, obviously, I would like to tackle. There's a few questions on Japan. It's not like the elephant in the room. This is the world's biggest kind of creditor nation at the retail level, certainly maybe at the institutional level. They're doing crazy things. I mean, when you look at the 30-year yield, it's gone through the roof, but the 10-year yield is locked at 25 basis points.
Yep.
Which is going to go? Is it going to be dollar yen to 170, or they're just going to go, oh, sod it, and we'll get 25 bips goes to 1.5, and actually dollar yen then moves back to 115 or 110 or whatever, 120?
I mean, look, if you listen to Kuroda, the man's not for moving, right? To use that great Thatcher phrase, right? And he just seems really determined to hold on to this, irrespective of the fact that Moff's getting their knickers in a twist because they're coming up to, upper house elections in a few weeks' time, and the yen is an issue. I mean, I have some sympathy with Kuroda because they're just not seeing the levels of inflation that we're seeing in the Eurozone. I can see inflation hitting 3.5%-ish sort of September, October, but they're not getting wage growth yet. So it seems less sustainable. I do agree with you, though. You're starting to see some interesting moves in these bond markets. You saw a big move in 10s, 30s, to your point, like the anchor 10s. This thing blows out. We've taken a stab at buying some downside in dollar yen, just because it's a real lottery ticket, Roger, right? I mean, at some point, if you think something's going to break, and stuff is starting to move to the point that you would think that something could break. I mean, it may not be, and you get two plays in here. You get the Kuroda does get pushed into a corner and a gun put up to his head and he changes. And you also get the idea that treasuries suddenly start to rally because we walk in, and treasuries have just collapsed, or the equity markets just collapse and treasuries really start to rally. They're just cheap lottery tickets. I mean, technically, the target is, to your point, it's 170, right, on dollar yen. If you look at the log chart in the yen, where are we? I mean, we took out the trend line, beautiful trend line from 86. We've now accelerated away. If you think this is an inverse head and shoulders, which kind of nice inverse head and shoulder. I mean, maybe not a perfect shoulder here, but
I think it's if you actually have a horizontal neckline, it's a beautiful.
Right. Yeah, I mean, the point is your target's basically 174, 175. Yeah. So, we'll see who's following the right policy in the end. Is it the Fed or it's the BOJ? I mean, I think the Fed is dealing with a much harder hand because of just this size of this stimulus that we threw at the economy.
Okay, so on that, which is, we looked at the negative side, and Joe B, amongst others, is looking at, what are the sort of things that would trigger a Fed pause? Because it's still that holy grail, but what is it? When do they pause? When do they go, do they carry on with QT from here? They carry on tightening. What breaks, what needs to break, and break by how far before they go, okay, is it we need to see inflation significantly lower, heading towards, as you say, that 0.3% per month?
Yeah, I mean, this underlies, I think, a bit of a problem. I mean, I think the Fed is obviously clearly focused on the economic data. The problem is, as we talked about, that because of financialization, it's actually not the economic data that leads the cycle, it's the market. It's the market that drives ISM, it actually leads ISM, it's the market that drives all sorts of things. So, if I were to answer it with my economic hat on, I would say, 0.2, 0.3 inflation prints. And a significant drop in job openings from that job survey, right? Or some other metric, claims starting to rise, increase in unemployment, that sort of thing. Those would be the metrics.
On the jobs front, I mean, I saw some recent stuff, we've had this drop in participation rate because a lot of people said, right, that's it, I'm done. I saw some data recently which suggested a lot of people who thought they could retire because of inflation may now come back into the market. So actually, and also with JOLTS, job openings is probably not the right way you should look at it.
Well, no matter how I look at it, Roger, and I think that's fair. Don't get me wrong. I think that's fair. I think there are some obvious criticisms, but however I look at it, if you look at teen employment numbers, right, post-war lows, you look at unemployment numbers, you look at post-war lows, you look at the NFIB data, most extreme number of, trying to hire, so however you kind of parse it, yeah. So however you kind of parse it, this is actually a very, very, very strong labor market. So whatever you want to look at, I like the JOLTS because you can kind of look at how many they're trying to hire versus how many they're hiring. And I think that's quite an interesting metric. But I agree with you, it may not be perfect. But to go back to your other point, I mean, what causes them to stop? Well, look, they should stop if the S&P drops 30%, right? Because
in total.
No, in total, top to bottom. And the reason I say that is outside 1987, which was really, for those of you who weren't around, and even you and I were still, I just was about to take my first job on Wall Street in 87. Even in then, that was more of a negative gamma flash crash around kind of portfolio insurance because they thought they had these synthetic options and it didn't work and the whole thing just flushed. So it was more a flash crash than the bear market, but a 30% top to bottom decline in the last 90 years has always given you a recession, right? Come what may. So they really should be looking at that. The problem is that they're not. They're looking at the real economic data. If the real economic data lags, hence why I'm telling my clients the odds of a policy error are rising inexorably.
It's because they're probably looking at I always say the ISM, in the era of moderation, you get to 45 for a recession. But if you go into the periods of inflation, ISM often went into a recession at 62, 63, and 54.
Right.
So I think this is all coming from the consumer and small businesses. I think big businesses are still sort of okay.
Yeah.
So I think means that, I think if people are looking, even though we discussed the yield curve, I don't think the yield curve will take the sort of time it's taken before. And in fact, in those inflationary periods, it tended to continue inverting into recession.
Correct, which is quite unusual because normally it bull steepens, so two-year yields start to drop off. But to your point,
that's the Fed fighting for growth, not fighting price. So I think that's one of those sort of things that might.
So look, to me, it's the equity market. It's the equity market. It's the equity market.
So, a question from Michael B: which breaks down first, energy or rates, or do they go together, or can one continue without the other because of, I guess, the supply shock issues?
Energy or rates? I would say, when he says break down, I'm assuming he means rates fall. I think it's very hard for rates to back off with energy prices this high.
Yeah.
So I think it has to be probably energy prices. I mean, it has to come from demand destruction, but that's extraordinarily tough to do. Right? I mean, even if you go back and look at the 70s, demand for energy flatlined. It didn't, because typically it grows with GDP, with some sort of productivity kind of adjustment in there for more energy efficiency. So no, it's very hard to do.
I mean, it's fascinating seeing the oil market just this week, everything that's been thrown at the overall risk markets, and energy keeps on going up, and energy keeps on going up, and the curve back end keeps on going up. Looks very, very tight. And as you know, UK gasoline price is equivalent of around about $9-10, although obviously half of that's taxes anyway.
Yeah, exactly. But it's not like it's getting that far in Chicago and California. You go for premium.
True. Yeah, and the problem is that the actual delta effectively in the US is so much higher. When it doubles, whereas
and also no one in Europe, as you well know, Roger, drives a car that does 14 miles to the gallon.
No. Silver and gold. Again, Monday, not great day for it. You're looking at an entry point, getting close to your 20 on silver. Where are you looking for those?
So, look, I've played. We had a really good run in silver in the spring of 2020. Sort of rolled it to sort of basically slightly more than double as a trade. But remember, it came off hard into that move, right? And I think, if I look at this, I ultimately think that at the depth of the pain, that the Fed will be forced to make a choice between, continuing to push up bond yields and essentially bankrupting the government at some point, and crushing the equity market and undermining the economy. And I think that they, and I call this the impossible trinity, the inability to control three metrics, keep three balls up in the air, and that third ball is the dollar. In the late 60s, they chose to support the equity market and bond yields. And particularly since we're essentially in a war, it sounds a little alarmist, but essentially we are in a sort of wartime footing, right? We are going into a new Cold War. We do need to spend an awful lot of money on weaponry. And I think the Fed will have to make a choice at some point. When they make that choice, when they blink, right? But I'm talking about from intense pain, okay? That's when the dollar goes. Clearly isn't going now. We can see it's quite the opposite. Okay, this is the napalm run, the risk-off dollar rally, okay, which, left to its own devices just leads you a bunch of charred holes and smoking bodies, right? From that point, that's when you buy precious metals. And technically, it's not very owned, okay, silver anymore. I mean, it might be underestimating how far it drops, but I think you can probably get it under 20. And that's kind of the one that I'm watching. So gold's actually been pretty well behaved, actually.
It's just
despite what you've seen, right? I mean, you can sit there and go, it doesn't fucking go up, right? I'm really frustrated and bang your head on the table. But you could have been in ARC.
Okay, so something that's connected to what we just not ARC, but what we've just been talking to from Will and Francis H. So quite similar. We sort of covered this already, but I think maybe just a direct one, which is what has to happen for the dollar to top out against the euro and the pound? And also, this is Francis H., do Treasury yields need to peak first before the dollar reverses? So kind of, what are your thoughts on what do we need to see? I mean, what is it if we're in that?
Yeah, I would think you need to see Treasury yields peak, and I think you need to see an intense degree of pain, be it in asset prices or in the real economy, that forces the Fed to blink. Right? That is absolutely right here, right now, the last thing that Powell intends to do. Is people have sort of described this as his Volcker moment, right? Where he says, screw you, I'm going to do the right thing for the long term. Okay, 40% down on the S&P, maybe, let's say. Gun to your head, unemployment's at 5. Quite how resolved are you going to feel?
And on that, there's a couple of questions, probably jumping the gun slightly in terms of your view on the market. But when we get to 40% down, what do you look to buy? Because it's not just,
right.
Down,
well, it really does depend at that point what the dollar is doing. If
Yeah.
I'm right about the dollar, Roger, you could buy a lot of stuff, but the best stuff to buy is the stuff that you haven't bought in the decade or so where the dollar has been strong, right? Because this is what people don't understand. You end up with these periods of dollar strength, which cause this sort of reflexive, self-reinforcing cycles where money flows into the dollar because it's rising. It goes into US assets, and that outperformance of the US asset markets leads to a strong economy on a wealth effect, right? And leads the Fed to raising rates, so the dollar rises even more. So it truly is, to use that Soros term, reflexive, okay? And it's great until something breaks, right? And we saw this, the last time we saw anything close to this was really from 95 into 2002 into the highs of the US equity market back then. And then the dollar started 6 years of steady decline. From 2002 to 2008, it steadily declined. And that's, if you look at this chart here, that's what I mean. So if you see this, here's the US equity market versus the rest of the world. So rising is the US outperforming. Here's the dollar. And you can see that the pattern looks quite similar, right? Now, I mean, it went on for a year longer when the US equity market had started to underperform because the bubble was here, and maybe that will happen this time, but I don't think so given how we're funding some things here, and I think actually the dollar is potentially quite vulnerable if the equity market really goes. But it really hasn't gone yet in absolute terms, and I think it needs to. And then I think we could enter a period like this. And the reason why that's important is everything that you bought in this period, where the only thing that really performed was the US equity market in dollar terms, and tech especially, underperforms in this period 2002 to 2008. So you could buy tech, it will go up, but the stuff that you really want to own, energy, mining, metals, broad commodities, emerging markets with exposure to those, and you want to run that currency exposure and not have precious metals and not have that dollar exposure, because the returns could be ginormous.
I mean, if I could tick all the boxes I want in terms of putting money to work, it would be a final run higher in the dollar, which is a risk-off dollar move higher, napalm, as you say, which creates that correlation event, which sees even the commodity stocks
go down,
coming down to what will eventually, hopefully, be that final low. Whether it's in a year, who knows? And then you go into international commodity stocks, hopefully with a weaker dollar tailwind behind you, but also having, fingers crossed, touch wood, you've had that little bit of weakness. So that's kind of how I'd think about playing that. Now, question that's sort of half out of your comfort zone, but is partly in, which is from Sindra K, which is, when do you think the disconnect will happen between the strong correlation of the NASDAQ and crypto?
It's tough because the problem is, and this is one of the things that I've talked about. I mean, the NASDAQ is a long duration stock, basically, and crypto has been highly correlated to financial conditions, and so's crypto. When does it break down? I would guess probably when the dollar starts to go, right? That would be my gut decision, right? Because maybe if we go into a weak dollar environment where money isn't naturally attracted into US assets, Roger, because the dollar is going up, that kind of, that US exceptionalism thing that I just showed you. At that point, I think that's when you could start to see crypto come back. But the problem is it could be a long time, guys, right? As I said, we're not there yet. You just described a series of events, which I think is spot on, that gets you there, and we're not there yet.
Gary M. So one of your successful trades, but you talked about, is no longer set up nicely because of volatility. Is HYG, your short HYG has obviously done well. How you've talked about also how now it's really an equity trade in some ways. The first bit's over. But how would you play the credit market? Would you HYG, if you've got the balls to just be short outright potentially? But let's say, are there any other tools that we can touch that are similar to that? Obviously, institutions would be playing in the credit market.
They'll do CDX, they'll do all sorts of stuff. It really has to be HYG, and this is, I would not sell it here, right? This is the lows of HYG in 2020, which was the end of the world, were 69.75. We're at 73.25. Really?
Do you think we get into a proper credit event? Because we sort of, since 2008, things have been supposedly improved, and there's always been. I remember I actually sent you a chart a few months ago and said, "Oh, this is the wrong time for the Fed to. This is exactly the wrong moment in time in the cycle." And what I meant was the actual asset cycle. Every time we've seen those dips in HYG, the Fed had relented, or they'd either held off on doing more rates, or they'd done QE, or they cut rates, etc. But now they're going to tighten. So although it's come down to those sorts of levels, it looks like it's probably, the Fed does what they're going to do. Isn't it going to go down to 2008 type levels?
Well, it could do. That's clearly the risk, mate. That's clearly the risk. And but look, I just showed you the chart of the NASDAQ and the 40-month moving average, right? I think that's a much more compelling trade than trying to chase credit at this point, right? I think they're all the same trade, right? They're all the same trade. I think it's just an easier one to potentially control. I mean, look, the Nasdaq. HYG could go to 64, 63, something like that, right? That's with the lows of 2008, Roger. But that really was a credit event.
Potentially, there's quite a bit of leverage out there right at the moment.
Yeah, I mean, the big leverage I think is in this private equity stuff, right? I mean, I don't like that at all, right? But that's a difficult, even more difficult one to trade.
Europe.
Yes.
Talk about Europe. I mean, I can't quite find it here, but basically, there's a couple of people sort of saying, is Europe uninvestable at the moment because, where does the ECB go? It wants to tighten to fight inflation, but if you tighten, you potentially have the problem with BTP spreads, with Italy, with the banking sector, which didn't clean up its act post 2012. How do you approach Europe? Because even when I look at US equities, I sometimes go, even those dodgy growth equities in the US still look better than half of Europe.
I mean, look, it's been a problem. I mean, it is just the ECB, I think, more even so than the Fed, are just in la-la land, right? I mean, I think the Fed has dropped that bucket of cold water over themselves and woken up to the realities, and the ECB is still sort of standing there. I mean, Lagarde is basically, twiddling while Rome burns, and I do think they think that they have in the existing facilities the ways to deal with the BTP problem, but it hasn't been addressed thus far. As I said to you, I don't think Lagarde could have done a worse job if she tried, compared to what she did the other day. And this thing goes until they step up the plate. I mean, they have got to address this falling euro. I think they played this horribly. They should have done what the S&B did and actually talked the currency up, right? You make the point about the US wanting a stronger currency, right? The ECB could have come in and they could have said, the euro is too low. We think the euro needs to go up. We're going to raise rates a lot. They might not have actually raised rates a lot, right? They could have kept QE and the various plans in place. They could have raised rates a little, and they'd have got that tightening of financial conditions mostly by a rising euro. But now, I mean, it's a falling dagger at this point.
And one thing sort of a couple of people mentioned, which I want to sort of look into, which is, and something you talked about as well, which is the reaction function of central banks when you've had these scenarios before. You talk about the 1960s and 70s, how you had the move up in inflation and then they raised rates and then the equity market sold off and then they relented and it went up again. Today, we also have that risk where, the number of times you hear, the problem with this inflation was we'll deal with it by doing more fiscal input. We'll spend more money, which is the problem in the first place. Do you think that actually over the long term, the risk is that policymakers go, there's a problem. They've got a bit of inflation. People are poorer. So we'll give them some more money, which, there's a hole in my bucket. So do we just keep on going?
Yeah, I mean, I say, fiscal rectitude got taken out to the bike shed and shot in the forehead, right? I mean, to your point, you look at all of these places that should not be handing money out, places like where I live, at the moment, not saying I'm going to stay here for long, but it's kind of fun while it lasts. Chicago, right? That is with the pension problems and the deficits that they have, they were handing out, checks to people to help them with, and free rail cards, right? I mean, just absurdities. But it does seem to be that the attitude is to spend more money. I mean, I met up with a Republican contact of mine who's very well placed politically, and I said to him, look, so you win Congress, you win the election, this fall, you control both houses, you've got Biden in there, we end up with a recession in 23, you're looking at elections in 24, what do? Do you spend money, or do you play hardball? And he said, thought about it for a minute, he goes, no, we'll spend money, just depends on what, right? And this is the problem. I think that Trump started it, really. Fiscal rectitude is gone. And I'm afraid that embeds that inflationary system in the mechanism, Roger. I think that's what happened in the 60s. The question is Powell going to nip it in the bud? And nipping it in the bud means absolutely crushing this thing right here, right now, or our market's going to put him at a point that he's going to have to make a deeply, don't think this will happen easily, unpleasant decision, and come in and do QE to stop a bond market going to 5 or 6%, right, or an equity market going to down 50%, right? I do not preclude those scenarios at all.
Okay, so just now to really wrap it up, it's the unfair question, really, but which is not. I'm going to ask you where things go, but you just mentioned it there, time frame. So how do you see this playing out? So one is that they go Volcker squared right now, and we have a low, maybe even before the midterms, because they just go actually 75, and we might do 100 if we need to, crash, whatever. But let's say they kind of go 75, 50, 75 tomorrow, but they stay relatively measured, and inflation peaks at 9, but drifts, and it's compounding at a high level, sort of high mid single digits.
Yeah.
Over that sort of scenario, what are the scenarios where this could play out? Because obviously a lot of people have put questions in, which is, what should I buy? When should I buy? What should I look for? But what are the timeframes that you think this could play out? Because it feels that this is going to be somewhere between, if 2020 was the shortest and 2003 was one of the longest, it feels more like it's going towards 2003 in terms of duration.
Yeah. I think that's, as I said those sort of .com bubble charts, right? I mean, it took 2 or 3 years to kind of fully pan out. I mean, this is unwinding relatively quickly. The fact that you're not getting the bounces suggests it's actually a little bit more painful than that it could happen quicker than well. I mean, look, COVID was totally unusual, but I'm in no rush yet, Roger, to buy anything. I want to see real blood, and I'm sure there's some people watching this who are invested in crypto. I'm deeply sorry. I've been pretty damn clear about my views on crypto, and I'm sure there are people who invested in ARK, and hopefully you made profits elsewhere and you can offset losses in ARK in that. But I think this thing has the beginning of, it just isn't letting you out, and it seems to just be grinding and grinding and grinding. And fine, if the Fed chooses to go 75, then just 50 is the new 25, and we ratchet this out, then maybe the obvious time to go would be September, October, right? I mean, that's the classic time that the equity market just goes, bye-bye, I'm out of here. I'm not seeing the signs of capitulation that I ran through earlier. If I start to see those, fine, but I'm not. And I think people forget that if you go back and look at a chart in the mid-60s, you saw periods where bond yields rose materially in late 69 into 70 as the equity market dropped 35%. Right? I mean, the bond yields went whoosh, and this thing just ratcheted down. So I think we'll get to a zenith probably September, October. Where does it go from there? I mean, if I'm right about the dollar, I'm not going to be reinvesting in the US, particularly outside something that's very dollar sensitive like mining's, metals, and whatever, for a decade, possibly. I'm going to buy other things, I'll be fully invested in other things, but I'm not going to be invested here in the US. I fear that the US has had its decade in the sun. We've built the bubble just like we did in 2000.
Great. Lovely. It's always a pleasure. I tried to tease out a few optimistic bits there, but Julian, as always, great stuff, brilliant stuff. Love listening to you. It's been a great call so far this year, and
thank you, sir.
It feels like we're still very much in it, unfortunately.
In it, I'm afraid. Yeah, I do. As I said, I do think that. I do think the opportunity is enormous. I mean, we've been running XME against the S&P. It's hardly gone anywhere yet. I think that's going to be a 5-6 bagger, right? I mean, I really think that's going to be an incredible trade. It's just right here, right now, in this part of the corrective process, Roger, that I call the nasty correction, right? Where kind of everything dropped, some things drop more than others, but nothing really performs. It's not a bad thing to have cash, right? Yeah. So that when it hits that ipso collapso moment, right, you have the money to invest. That's what I've been trying to tell people for, since November of last year, really. Have some cash, raise some cash, be careful, have tight stops, right? And we will get back in full blaze when we think the time is right, but now is not right.
Brilliant. Thank you.
Thank you, sir.
Thanks, Julian. Great one. Thanks everyone for watching. Hopefully that was helpful. And I don't know if there's comment section, but obviously stick your comments in there if there is.
Cheers. We'll try and answer them as well. Thanks. Bye-bye.
See you later. Thank you.